Let's bring in Dan Greenhouse now of Solus Alternative Asset Management and Lori Calvasina of RBC Capital Markets. Good to have you both with us. The market, Lori, feels like it's right now anyway, 2 steps forward, 1 step back based on, headlines that are deemed to be overly positive. Market explodes higher. Market responds to a little bit of watered down headline. And here we find ourselves. So what do we make of all of it?
So, look, I think there was this debate, right, going on throughout March. Is there or is there not a Trump put? Is Trump paying attention to financial markets? What's happening, with the trade war? And it does feel like some attention was paid, whether that was to equities or to bonds. It does feel like we've sort of hit that turning point for now. And I think markets are still kind of bumping along this bottom of what we call the tier 2 of fear, which is a growth scare, fear of a recession or a crisis that doesn't materialize. I don't think markets have been sold yet on the idea that a recession is coming or a major crisis is coming. And I think we're reasonable to hold where we're holding.
Yeah. I think it's a good point. I mean, it does feel like that the markets have gotten the president's attention in one form or another. Bond market getting angry, the dollar doing what it had been doing prior to today, this gold move exploding. Now it is obviously getting hammered. And then you end with the stock market doing what it did. Is it a change that we need to pay more attention to, if in fact it's true?
I don't think, well, listen, clearly it happened. The reporting bears that out, and those of us who were just watching the change in tone following the market sell-off, both equity and bonds, saw it happen. So I don't think that should be surprising to anybody. Do I think it's a change? No, I don't think it's a change. I think the ultimate goal here for the administration is clearly unchanged. And so while I think they're dialing up and down the rhetoric or the goals or level-setting expectations in response to markets, they're still trying to skate to the same place, reducing the world's reliance on China, reducing the budget deficit, reducing the trade deficit, reducing the value of the dollar.
Yeah, but the market's reacting like it. Earlier today, it was like, I'll go with you on the skating to the same place, but we were speed skating until Besson spoke again, and now we're sort of like we have the beginner walker on the ice again because he's talking about 2 to 3 years.
I'll borrow your phrase, 2 steps forward, 1 step back. But also the 2 years, I reject the idea that the narrative put out there, our friend Torsten Slok talked about this, trade deals take 2 years to put together. I reject that. They're not trying to negotiate NAFTA-style trade agreements. They're trying to lower tariff and non-tariff barriers, something that you can do in a one-page Word document in 15 minutes. You agree to do X, I agree to do Y. I don't think these have to be...
Claim victory and then we're all good.
Claim victory and we're off. And part of the reason I've been more optimistic than many others, which is a very low bar.
You actually have been.
I thank you for the actually. It's a very low bar, admittedly. I mean, it was suicidal here for a while. But part of the reason was on the idea that you didn't need a NAFTA-style trade agreement. You could get some modest headlines, some modest concessions on everybody's part, declare victory and move on.
There are those who, though, say this is nothing more than bear market rallies, and that, you look at the S&P, 2/3 is down at least 20%. You may not have, the textbook definition of a full bear market, but nonetheless, the market, it walks like a duck, talks like a duck, call it a duck. I mean, Wolf Research today says remain defensively positioned because of that. Did you take issue with that?
Well, look, I think that unfortunately visibility is limited and there's still a lot of fog in the outlook. And we're all paid to make forecasts. And sometimes we have to be intellectually honest and say that's more difficult than it should be. And so what I've actually been advising clients to do in terms of sectors is short term. We don't know how long the short term is going to be, but I like utilities. So if you want to get defensive, buy some utilities. I'm overweight there. But I've also done this a long time, Scott, and I know that, we always feel despair at the bottom, and we only identify it in hindsight, no matter, how good we are. That's just a reality. And so I also want to use these opportunities in the market to add to some offense. So we also like financials. They're not going to both work at the same time, but they serve different purposes in a portfolio.
I just want to add also real quick. I get it. There's a lot of pain underneath the surface. X number of stocks are below the 50-day moving average. Y number of stocks are down 20% from the high. But 8 of the 11 sectors are outperforming the stock market. Yeah. The S&P is down, call it 8 and change percent. Yeah. And not just outperforming, the worst of the 8 is energy, which is twice as good, is down only 4% year to date. It's really those big tech, and discretionary, which we all know is, of course, Apple is Amazon and Tesla, which is doing a lot of the heavy lifting here. So to the extent that you've overweighted one of those 8 sectors, including utilities, which is the best, on a relative basis, you're not doing terribly.